Good afternoon and welcome to the MERCIA Asset Management PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Mark Payton, CEO. Good afternoon, sir.
Good afternoon and welcome everybody to MERCIA's interim results for the period 30th of September 2023. I'm sure we've presented to a number of you, but for those that are new, again, welcome. One of the changes since our last presentation, our prelims, is I'm pleased to say that the executive team has been expanded to add Joe Bath, Chief Operating Officer, to the executive team. Joe joins us from Oxgene, where she previously was COO, a business that grew rapidly, and a number of you will recall we exited that business. It was a very strong return for our EIS funds as well as for the balance sheet, and we're pleased to welcome Joe on board. To my right, presenting later on, is Martin Glanfield, MERCIA's Chief Financial Officer.
Yes, good afternoon, everyone. I joined MERCIA as employee number 7 in October 2014, just over 9 years ago now, to IPO the business with Mark when we had £22 million of funds under management. And my background is mainly as a CFO of publicly listed and privately backed technology-enabled businesses in the UK and the US.
Thank you, Martin. And to my left is Julian Biggers, MERCIA's Chief Investment Officer.
Hi, good afternoon, everyone. So I came to MERCIA via the 2016 acquisition of Enterprise Ventures. All the way back to 2003, I've been working in venture, managing various different funds for Enterprise Ventures and then latterly MERCIA, and now sit as Chief Investment Officer across all of MERCIA's equity investment offerings.
Thank you, Julian. And we're coming to you today from our main office in Henley and Arden, and the schematic to the left just demonstrates the offices we have across the country. We have something like 11 offices delivering capital across the UK. This slide nicely highlights why we believe this to be a very strong period for MERCIA and its continued growth. We've seen assets under management grow to 1.5 billion. That's up 1.7% compared to our last reporting period. Revenue has grown to 15 million. That's up 23.5%, and that's compared to this time last year. EBITDA has grown to 2.8 million, up 33.4% again compared to this time last year. Importantly, in the current environment, at this period end, 36.5 million was what our cash on hand position was, following the recent successful sale of Endreams, a profitable sale of Endreams. That cash has now grown to 60 million, debt-free. I'm pleased to say that the progressive dividend policy continues to be delivered, with the growth of the interim dividend by 6.1% to 0.35 pence per share. And as a number of you will have noted, we announced today a share buyback as well of up to £5 million. This slide here just demonstrates the growth, and actually just choosing from the COVID period to now shows the growth of assets under management on the left side, the green being total AUM, the dark blue being third-party funds, and the light blue piece being our proprietary position, our direct investments. And you can see that steady growth over the 3.5 year period, predominantly driven by our growth in our third-party funds under management. And to the right side, you can see the associated growth in revenue driven by those third-party funds under management and the commensurate EBITDA growth with the growth in the third-party funds under management. And the final position there is where we are at this half-year period. We would expect at the full year for that upwards trajectory to continue. And in respect of our proprietary position, our direct investments, again, drawing the analogy from the same period, COVID through till now, so a period of 1st of April 2020 to September 2023. What this table on the right demonstrates is the net cash invested over that period of circa 57.6 million, and the returns, importantly, in cash over the same period of 86.8 million. In other words, the balance sheet portfolio is maturing. The cash that we're putting to work is returning cash to fund the growth of the business going forward, which is important as we contemplate growth within our own means. We have enough cash on hand to not need to go back to the city to raise money, as we said many years ago we wouldn't need to, and indeed not go to banks to raise debt, to remain debt-free. The rows below that just show the movements in terms of realised gains and losses and unrealised fair value movements. And that just really demonstrates the trajectory of what is a venture portfolio, but is fundamentally delivering cash. A little over 2.5 years ago, we set out on what we termed the MERCIA 2020 vision, the 3-year strategy, where we sought to grow assets under management by 20% per annum over a 3-year period, averaged, if you like. Or another way of looking at that is assuming starting from just under 1 billion AUM after the 3-year period to have rise that by over 600 million to 1.6 billion. And then profit before tax, looking at 20 million per annum over a 3-year period averaged, or again, maybe looking at that as a 3-year cumulative position to 60 million. In terms of AUM growth, we remain confident that the 1.6 billion will be met, and we'll talk later on about the organic prospects for that. And in terms of profit before tax, although at 31.2 million over 2.5 years, that is going to be very difficult in the current environment that we find ourselves to achieve the 60 million. The progressive dividend that we talked about just a moment ago, that is demonstrated by the growth in the highly profitable third-party fund management operation that in large part supports that. And to that point, the profit before tax is in large part supported by our direct investment strategy. And at the moment, as I said, the majority of the portfolio is in venture, and venture is in a challenging arena at the moment.
Thank you, Mark. As you can see, we achieved more solid growth in assets under management during the 6-month period, and there were once again no redemptions. From a starting position of 1.4 billion, we added 45 million of new inflows. We experienced a very small reduction in fair values across our asset classes, and we distributed 17 million pounds to our investors. And on the right-hand side of this chart, you can see where the 45 million was raised from, being EIS, VCT, and Business Bank, and the North East Venture Fund. And post-period end so far, we've already raised an additional 10 million pounds from another EIS fundraise and from the British Business Bank. And currently, our VCTs have launched a 60 million pound fundraise, which is going well. We're confident that there is far more organic growth to come in the foreseeable future. This slide provides more granularity on the makeup of our 1.5 billion of assets under management by asset class, investor type, and fund type. These varying fund types are typically either evergreen or long dated and are generating a blended fee margin of circa 2%. 80% of our total revenue is contracted and recurring, and in the 6-month period, 97% of our revenues came from our profitable fund management operations. So as you can see, we are well diversified by asset class, and we can invest UK-wide. This is our P&L account for the first 6 months, and as you can see, the headline here is the revenue growth of 23.5%, but that obviously also includes the full 6-month period of the ownership of Frontier Development Capital. And although it's been a challenging period from an inflation perspective in our cost base, where our underlying costs rose by 10%, I'm pleased to say that our underlying revenues increased by 11%. So we have been able to absorb the cost pressures which have affected not just the UK financial services industry, but the whole of the UK during this period. I think the other interesting point worth noting on this slide is that a year ago, the bank interest that we earned in the first 6-month period on our cash balances was £117,000, whereas in this 6-month period, we've earned £778,000 from our cash balances. And of course, that period was prior to the receipt of 26.4 million from the sale of Interim. Thank you. Our balance sheet remains rock solid at just over £200 million, dominated by the £142 million balance sheet portfolio, which has obviously reduced somewhat post period end from the sale of Interim, but also the cash, of course, has gone up by the same amount following the exit from Interim, and it's a really rock solid balance sheet. And our cash flow position is obviously now extremely strong at 60 million. And what we have built is a very cash generative business built around our profitable and growing fund management business, coupled with periodic cash realizations from our maturing direct investment portfolio. And finally, for me, as you've probably heard me say before, for an AIM-listed company, we're very appreciative of the significant blue chip share register that we have, which of course includes circa 10% individual investors.
Okay, thanks, Martin. So the left-hand side of this chart does show our complete suite of investment products. So we can invest and lend from £200,000 upwards to 10 million as a business scales, and in certain circumstances, 20 million through our FDC funds. So on our venture side, that's split between our early stage venture activities, and we can write £500,000 to 5 million check sizes, and then our VCT scale up capital really look at 3 to 10 million of exposures. Regional debt teams do the smaller sub £1 million debt lends, leaving FDC to do the larger and some cases property transactions. And again, for our private equity offering, the sweet spot really is 4 to 5 million of replacement capital. On the right-hand side of this chart, again, shows that the split of that 1.5 million of AUM across those areas of activity, but it also shows our significant liquidity. And we are not suffering from any scarcity of capital across any part of our business at this point. And again, so without any new funds raised, and we are consistently raising new money, but without that, we have at least 2 years of investment runway, which is a great place for us to be. Thanks, Mark. So this slide shows the performance across our equity products, which again continues to be solid. So firstly, our proprietary capital, our balance sheet, is running at an IRR of around 13%. And just as a reminder, over the last 3 years to March, we had equity realizations of £340 million. Add to that for the 52 million to this period to September, and then 26 million from Endreams. So circa 420 million now realized over the course of the last 3.5 years. So we operate close to 45 or so funds, various different mandates, remits. There are different ages and geographical focus areas. So we use TVPI as the performance measure, and we expect this to increase over time. In venture, not necessarily uniformly. We can see that across our legacy venture and current PE, those numbers are ticking up over the last 6 months, and that's really a couple of recent exits in there. Our current venture activities are flat or slightly down. Again, not unsurprising really in the current market. And then onto our VCTs, the best measure is the total return here, which includes dividends paid out. So at between 2.5 times, again, some solid performance there, and again, pretty much flat over the course of the last 6 months. So I guess in conclusion, I continue to be happy with our performance in what has become a much more challenging period for venture and smaller private equity. Thanks, Mark. So this is our direct investment portfolio in numbers. So a little bit less complex than in July, but again, starting off on the left, bottom left, 137 million or so of brought forward value, to which we added 7.5 million. Then we have negative fair value movements of 1.6 to leave us with that 142.5 million of balance sheet value. So within our fair value movements, again, a number of upward moves here. So Dreams, again, you can see that number there. As we, of course, anticipated the November exit. Again, that transaction was in play at the 30th of September. VoxPop.me, again, a new round, which we put money into and also converted some older loans with very favourable structuring and conversion, as was the case to some degree on TON UK, which is intelligent positioning, and our two other software assets, Pimberley and Forensics, again, trading well and therefore enterprise values ticking upwards. So the four downward movements, Impression Tech, which is the largest movement, and again, we've impaired that value as we had an exit and fundraise process, and there was a lead buyer in that, which unfortunately fell away. So that process is going to have to be restarted. I guess somewhat similarly, but on IOTO, we had a setback in that, as you'll recall, we were in correspondence with the FDA over potential approval for the company's slit lamp product. Ultimately, the FDA came back with a requirement for further trial data. And again, so we are spending a lot of time on those two assets, really kind of reassessing commercial strategies, and we'll monitor them closely over the course of the next few months. There was a further small downward movement on Invincibles, and that's really only as the short-term debt in that business increased momentarily around the period end. And our only listed asset, My Health Checked, continues to struggle as a small public company. Thanks, Mark. So our top 10, first 5 here, a little bit more detail. So on Dreams, as you may well have seen, we have sold that business now in mid-November for an enterprise value of £91 million to our co-investors, Aonic. And the great part of that deal also was that we were allowed to reinvest circa 4 million back into Aonic, which we're excited about because it does give us a great opportunity to continue to benefit from the growth of not only just Dreams, but 7 or so studios that are in the Aonic stable, and potentially at a low overall risk level to us. VoxPop.me, again, is growing steadily, some $9 million of revenue now. We saw some churn in the early part of the year. That's been all replaced and is back growing, moving towards break even, and that's the focus. Some interesting partnerships, one with Microsoft and ChatGPT. That's really to help VoxPop.me generate some better, quicker survey questions for its own clients. Then MERCIA, again, also growing $6 million or so. Our biggest customer here has just renewed for 3 years, which is a great endorsement of the technology. And again, we've been working with the team, and there's a new chairman in this business as well, which is something we're excited about. VertTrade is one of our 2 mobile games businesses, and again, Cards, the Universe and Everything, which is the first game, is now at 250,000 regular monthly users. And the next question for VertTrade is considering whether or not they start to build a second game using its card play platform. Number 5 is MedHerent, and we are in the clinic currently with MedHerent on its testosterone patch, and again making progress with other third parties with their own developments as well. Okay, so on to Warwick Acoustics. So again, in the summer we announced the first OEM nominations. So this is for the company's flat electrostatic speakers. So this is a nomination onto one of the highest spec cars for a 2025 new launch. Actually, just recently, we're optimistic of some wider adoption across the range with that OEM. And again, we expect revenues to come from mid-2024 when we see some schedules of call-offs for those products. And again, what we are hoping for and optimistic over is second and third nominations with other OEMs coming across 2024. So going well is Warwick. As is Invincibles, which is a second mobile game. Again, Soccer Manager 2024, the latest iteration of that game launched in September, is tracking about 20% up on previous games, which is great. And we look forward to 2 new games coming out across hopefully Q1 and Q3 of next year. Impression Tech, we've already talked about. Then Intelligent Positioning, again, we are making some improvements to the user interface to hopefully abate some of the churn, which again we've seen in the middle part of the year. We've recently won some new customers and pushing very hard, and I think we'll get there towards break even in the early part of 2024. And lastly, in the top 10, we've got Locate Bio, which is orthobiologics, so bone growth area. We have undertaken a pretty comprehensive sheep trial with excellent results out of Australia, excuse me, and are in the process now of organising first in man trials, which we have FDA pathway cleared and ethics approval alongside a funding round which is in progress. Thanks, Mark.
Thank you, Julian. So we're very fortunate at MERCIA to benefit from diversification on a number of levels. One is that the sectors in which we invest against, so we're not overweight in any one area. One is indeed the strategic assets that we manage, which are debt, private equity, and venture. And the final one is diversification across investor type. We manage retail capital, public sector capital, and institutional capital, which is typically regional pension funds. And looking at retail, that's through enterprise investment scheme, venture capital trust funds. We manage approximately 434 million to date, which is just under 5% of the opportunity. The market, our market share is 5%, if you like. And looking to the next column, which is potential, our pipeline, our near-term pipeline, we're looking at a further 90 million to secure into retail. The next area, public sector, we currently manage circa 315 million of funds, regional debt and equity funds. There's an opportunity mix of over 300 million, again, coming in the near to medium term that we would hope to secure some element of. And then finally, across the institutional capital, there's about 180 million across private equity and private debt and property, again, which we are looking to secure in the near to medium term. So that's over 500 million of third-party funds on an organic basis that we have sight of going forwards, and is a key focus of the executive team at the moment. So why hold a share? Why invest in MERCIA? I think the first point here is just the strong liquidity, the strong cash on hand. MERCIA's got 60 million now cash on hand, debt-free, which is approximately half our market cap today in cash. And then outside of the balance sheet, looking to the third-party funds that Julian's just spoken to, approximately sort of 346 million of unrestricted cash across all asset classes in which we manage. The 5 million share buyback, or up to 5 million share buyback announced today, again, is a positive trend and a demonstration of MERCIA's strong trading performance and cash position. The progressive dividend, our interim dividend being up by 6%, again, was a stated policy that we continue to deliver against. Of our assets under management, about over 85% of those are third-party funds, are other people's money that we are carefully investing and returning cash back from. Importantly, of those third-party funds, 100% are closed-end. And what we mean by closed-end is permanent capital that we've got and we can depend on to support existing portfolio, as well as in the current environment, look for value as we make new investments. Those funds are not subject to redemption, and we can forward plan our strategic intent and use of funds. Those funds have a blended 2% fee margin across them, which is driving the performance of the profitability of the group. And in terms of our performance, our ability to allocate into the funds, to distribute into good deals and then bring that capital back again, is testament to the fact that we've had 45 million inflows during this period into existing funds. And on that basis, and on the previous slide that we just showed in terms of pipeline of opportunities in the near term, and by near term I mean 6 to 12 months, we are well placed for third-party funds under management expansion on an organic basis. That's circa 500 million on an organic basis. However, with such a strong balance sheet, with a direct investment that can turn into cash, as is evident for Interim, we are confident that we could fund accelerated growth through corporate expansion as well, as we will evaluate opportunities over time. In addition to that, with the growth of the business, circa 140 of us now, as I've said, across 11 offices, we have internal capabilities and competencies where we have identified adjacent platforms for growth as well, where we could look to grow into areas where we can use our existing skill set to do so. And in respect of the business across the management team, employees and the board, we collectively own 17% of MERCIA, which shows good, strong alignment to the other owners of MERCIA. And the final point I wanted to say here is MERCIA has never been in a stronger financial position than it finds itself in today. We have growth across the group. We have growth in all strategic asset classes we manage. We have sight on strong organic growth in third-party funds under management, and we have a stabilized direct investment balance sheet that is delivering cash, as is evident from the Interims. So thank you very much for your attention. And I look forward to answering some of the questions. In fact, we'll endeavour to answer all the questions that have come through.
Perfect. Mark, Martin, Julian, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to read those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. If I could just hand back to you just to read out the questions and provide responses where it's appropriate to do so, I'll pick up from you at the end.
Absolutely. And what I've done is I've themed these, because there are themes, as one would expect, coming through, and we'll look to pass this to my colleagues of Martin and Julian where appropriate. So the first theme I'll pick up is to do actually with our investment activity. And I'll assume it's mainly equity, but Martin sits across debt. So I'll also ask Martin in respect of debt too. So in terms of equity, Julian, given the current economic climate, have you adapted investment strategies to continue sort of, you've picked wisely in your team, but to continue to do that going forwards?
Yeah, I think we have to be alive to the current environment clearly, and what we are doing, no surprises here, is concentrating on our existing portfolios first and foremost, and also concentrating on planning for and arranging the syndications that are required earlier, because those are taking longer to put together. We are always looking forward, and we're trying to fund our businesses into the future. And again, I think it's fair to say we're looking to extend those runways, and that's either by adding more cash or encouraging the companies to be making slight changes to their investment models and strategy to enable themselves to be looking further into the future. So perhaps 24 months of runway is the ideal when we put money into a business. And then of course we're carefully looking at some of the sectors that you would expect to be affected, and that's anything that perhaps involves any consumer spending, but also kind of high capital requirements, etc., which again we know are going to take longer raise. So I think those are the salient points there, Mark, in terms of our own strategies.
And Martin, across debt, are you seeing similar things and approaches within the portfolio and the debt team?
Yes. So there's sort of three parts of the country really where our debt teams are based. So Yorkshire and the Humber, where we are managing British Business Bank fund. The level of inquiries there is holding out really well. Average investment size is about £300,000. These are businesses of all shapes and sizes. They've all got to be profitable because they've all got to be able to support the loan repayments and service the interest. A lot of them will have taken out loans during the COVID period, which now need to be repaid, and so there's some refinances going on. But these are, pretty solid young or mature businesses actually that just want to shore up their balance sheets. And in the Northwest, our team there are more focused on small buyouts, an area where the main banks have left the arena. So probably lending up to £1 million for a small buyout or a small buy-in, and their work in progress is particularly strong. And then down in the Midlands, FTC, we're just about to celebrate the first anniversary of that acquisition. They've done brilliantly, and we're really thrilled that they're part of our group. The integration went really smoothly. They're a fantastic bunch of people. They're delivering the expected results for us, and also their WIP is holding out quite well. In particular, I think the commercial property space is holding out well. And they are, optimistic that they will be securing additional fund mandates in the coming 6 to 12 months.
Thank you, Martin. And Julian, just on the theme of investment trends, are you seeing AI featuring more in proposals and opportunities, and is that impacting and affecting your investment decisions?
Again, I think I'll answer that the same way as perhaps we have done in the past, in that AI, perhaps used to be called machine learning, very similar sort of technology angle, big data, etc. But we're not looking specifically for opportunities that have AI, but we are certainly encouraging all of our portfolio companies to embrace it. And there's some examples I've already suggested. There's VoxPopMe has a specific partnership with Microsoft to use ChatGPT. Even on Invincibles, so they are using AI and have done for an awful long time actually to try and predict the point at which a player of their game actually leaves the game. So that's the optimum time to send an offer or a deal or a reminder. So we are certainly encouraging our portfolio to use it as I think we should.
Okay, thank you. And just keeping the pressure on you, Julian. So we've sold Interim within the balance sheet, and we've often talked about sort of diversification across sectors on the balance sheet. So does the sale of Interim influence our divestment strategy or our overall portfolio balance strategy in that regard?
I don't think it will, Mark. Really, because don't forget we are already diversified by sector and by stage on our balance sheet, and don't forget we still have an ongoing interest in VR and AR with our stake in Aonic, and that alongside the two games businesses already in our portfolio. So we're kind of diversified by swapping an interesting investment opportunity for cash. So I think that's diversification in its own right.
Okay, thank you. Now we have, Martin, Julian, a large amount of funds under management. We've got EIS, VCT, regional debt, venture, we've got private equity, institutional. So this is quite a difficult question to ask, so I appreciate if you can do it succinctly. But what flexibility, Martin, in terms of the debt mandates do you have in terms of selecting investments? Are you beholden to the fund providers and you have to choose what they're doing, or can you choose? What's the process there? And do you have to get all the money out in a quick concession, or can you keep some of that back, etc.?
Yeah, so again, let me go through, if I may, through the three regions I talked about. So the British business mandate is to be predominantly invested in the Yorkshire and the Humber region. It is a 10-year mandate, and we're coming to the end of the first 5-year investment phase. And we have done well in terms of the number of investments and the quantum of investments that we've made throughout the period. And so we will begin the realization phase for the next 5 years in the new year. In the northwest, again, where the WIP is strong, our lending criteria goes up to about £1 million. That fund is also in its investment phase. It's got about another 15 months or so to run, and then we'll go into a 5-year realization phase. And so that's at the moment, that's very active. FDC is managing, I think it's about 9 funds at the moment, and they cover a wide spectrum of lending criteria under their mandate. Some can go national, and some are very much focused on the West Midlands, ranging, as you've seen in the earlier slides, from sort of 2 million to 20 million in stages, particularly on the property side. So yeah, wide-ranging mandates. Some are evergreen, some are 10-year funds. Yeah, and all with, as you've seen again in the slides, all with great capacity to lend, all profitable and all doing well.
I think, I know, Martin, you sit on the investment committee, but the investment decisions are in-house.
Yeah.
The deals are sourced in-house.
Yeah.
And so it's very much an initiative driven. And we often describe ourselves as an impact investor, because what we're doing is we are investing for profitable reasons, but because we're investing across the UK and in the regions, we're seen as we create jobs. We're investing in businesses that others don't see because they're not based in the regions. So it is a broad, and I apologize, a broad sort of question there, but Julian, same question over to you. What's the level of independence really in terms of the funds we manage, and do we have to get all the cash out of the door? Are we free to keep hold of that?
Yeah, so again, it does very much depend, is the answer to that question. So for example, our regional equity funds, they certainly do have geographic restrictions, which we know at the outset. There are some targets that our LP investor, primarily British Business Bank, want us to achieve, and that would be anything from within certain sub-regions to some kind of sectors. We also have some restrictions that are placed upon us by both our LPs, but also from regulatory regimes. For example, in the VCT and EIS, there's kind of age restrictions and sectors that aren't eligible, but they are relatively small. So we are normally free. As long as we understand what the LP or the retail investor actually wants, we are relatively free to go and find the best investment opportunities. And again, in all these funds, we do very carefully look at how much capital is required on day one, but over the life of an asset. And again, the restrictions that we have normally allow us to be very well prepared for that duration of life of the asset as well.
Brilliant. Thank you very much. And the next few questions are more sort of corporate central focused in that respect. So the first one here, Martin, actually, is should we expect a consistent trend in future dividends?
Yes, and the short answer to that is yes, because as we've stated for the last few years now, our dividend policy is what we call progressive, which is that we do anticipate growing the dividend year on year, rather than it being anchored to some form of profit multiple.
Thank you. And another one, I'm afraid, to you.
That's fine.
Is there what are MERCIA's regulatory capital requirements?
Yes, so we have 4 regulated entities across the group. For 3 of them, it depends on the nature of their FCA permissions. For 3 of them, the required capital adequacy is negligible. It's down at the sort of the £5,000 level. For MERCIA Fund Management, which has different permissions, its regulatory capital is higher, and there what we have to do is build up over 5 years to have 25% of our fixed overhead base, so excluding things like bonuses, as capital. And over that 5-year period, and I think we're probably 2 years into that now, we've got to build up over 5 years to about £3 million. So we have more than enough cash to hold to meet those capital adequacy requirements.
Fabulous, thank you. So, a number of questions on the share buyback. So, in respect of the fact that we're relatively illiquid shares, we're a small cap business, how long would you anticipate the £5 million share buyback perhaps taking?
Yeah, that's a very good question. So, assuming that the full 5 million is used to buy back shares at roughly today's share price, if you assume that to be somewhat constant, then it will be 18 million, roughly 18 million shares would be bought back with the £5 million. And between Canaccord and Singers, they have set to maintain orderly markets, etc., and to stay within the safe harbour provisions of the market abuse regulations, they've set a weekly buyback limit of 1 million shares. So, assuming that there was the demand every week to buy back 18 million shares would be in the region of 18 weeks. Although, obviously, if the demand is much lower, it could go for as long as up to a year also.
Thank you. And considering the strong cash position the three of us have set to date, why cap it at 5 million? Why not do more than 5 million?
Yeah, it's always a balance. If you had sort of 4 accountants in a room, you'd probably get 5 opinions. Speaking as one. And I think what we do is we start at the end and we work backwards. So we look at all the other requirements in our business over the long term for cash. So we've never any intention now of coming back to the market to raise more money. So what do we think we need over the next couple of years or so for the balance sheet portfolio? What do we need for dividends? What do we need for deferred consideration? What do we think we need for corporation tax? What might we like to do from an M&A perspective? And then what's left? And it's always a balance. And we felt that £5 million was the right amount. Bearing in mind, obviously, also that with the number of shares in issue and the share price, that we are capped at 10%, rightly, we're capped at 10% of our issued share capital anyway. And this buyback at 5 million is circa 5%, it's circa half of our authority. So in the round, we felt that £5 million was the right amount.
Smashing, thank you very much. One question was about the strategic priorities, and I'll pick this up. So we have made historically 3 acquisitions, and after each acquisition, we've seen organic growth in FUM following that. So very much our AUM is built up partly through acquisition, partly through organic growth. But the central philosophy here is a domestic investor and a domestic impact investor. So the capital that we're managing, I spoke about retail capital, that's tax efficient capital. EIS and VCT is brought in to address a market failure and hence the tax efficient nature of it. So tax efficient capital is one part of it. The regional pension funds that we manage are very much our regional. They're looking at putting capital to work within the regions, helping businesses grow, creating jobs, etc. And then public sector, such as British Business Bank, again, are looking to address market failures, as they would term it. What we've done and built a business and model and systems is that we do that profitably for those investors as well. Our strategic vision is to continue to do that so that we become the first choice for investors, for investees, and for employees, so that we can be the impact investor across the UK. And another question that was brought on was FDC. Was FDC just acquired for asset gathering, really, AUM gathering? Well, that fits quite nicely with the strategic question, actually, which is they too are an impact investor. They too are managing regional funds, and those regional funds can be pivoted across. So what I mean by that is that you can move those to adjacent asset opportunities, because it's about relationships very often with the capital and trust with that capital, the cultural fit, their impact investment philosophy, and our strong confidence that, again, we can grow AUM from that acquisition was very much the rationale behind that acquisition. And I believe that is all of the questions answered, I'm hoping anyway.
Yep, perfect. Mark, Martin, Julian, thank you very much for that. I think you've addressed all those questions from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Mark, could I just ask you for a few closing comments?
Yeah, one question just flew in, and I think it only right and proper, because we always say we will answer those questions, talking about the abolition of EIS and VCT. Actually, there is no abolition of EIS and VCT. What was very pleasing in the autumn statement was the sunset clause that basically limits its life, which was due to end next year, has been expanded now to 2035. So that's a thoroughly big positive. And what we're seeing in terms of appetite for the tax efficient structures of EIS and VCT, which is what we manage, that appetite has gone up, and we are now one of the preferred investors across those categories. So we see further growth there. So I just felt I should answer that. And then just bringing that really, and I'm hoping people have picked up this central theme today, which is we're in a very good position. We see growth and momentum across our third-party funds in particular, and across all investor types. We see continued growth in the profitability of the group and that progressive dividend policy that's associated with. And we are really looking forward to updating all of you at our prelims to reflect on that continuation of profitable growth. So thank you very much for everybody's attention. We really appreciate it, and we really appreciate the questions as well.
Perfect. And thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MERCIA Asset Management PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.